Welcome to Classic Value Investors. My name is Mariusz Skonieczny, and with me online I have Jay Mintzmyer. Jay, welcome back.
Yeah, Marius, thanks again for having me. I think it's been a few months since we talked last, and I'm excited to be back and chat some more.
Yeah, first of all, before we get started, I wanted to congratulate you on recently you said that your Value Investors Edge on Seeking Alpha has been the fastest growing platform. So congratulations on that.
Hey, well, thanks, Marius. There's been a lot of interest throughout this entire year in the shipping sector, but I think most recently, right, there was that big surge in interest in crude tankers, but just overall, right? I mean, there's a lot of volatility, and folks are looking for research into the shipping sector, and we've been happy to deliver our analytics platform. We just did a major upgrade, the earnings season coverage, and so on. So yeah, thanks, Marius.
Yeah, so like you said, it's been probably a couple of months since we talked. So let's just start with this. Like, what happened if from your chair in the tankers market over the last couple of months? So just say whatever you feel is important.
Yeah, absolutely, Marius. Well, tankers have been interesting the last, I would say, almost like 9 months at this point. There's been a very good long-term supply and demand backdrop for tankers. On the supply side, we have basically the oldest fleet balance we've ever seen. We have a very small order book. We have a lot of regulations that are going to force out older tonnage. So that's the supply side, best it's ever been, in my opinion. And on the demand side, we also had some very promising fundamentals. One of the biggest promising increases was in ton mileage, which is just the distance, the oil has to travel. And we were looking at a lot of surging exports out of the US Gulf over to Asia. And that route is double basically the distance from the Middle East Gulf, right? I think like Iran, Iraq, and Saudi Arabia over to China. So not only that, we were going to see double the transport growth on a very clear trajectory. Like it was obvious that Asia was importing all the oil and that the US was growing their exports. Well, that was the backdrop a year ago, and that was kind of the big picture view, and folks were kind of picking up on that. Well, first we got distracted by the Costco sanctions, right? Remember last fall when they had those Costco sanctions, and rates went ballistic, right? And the rates went ballistic because the market was already very healthy. So if you have a very healthy, balanced market and you take out, initially it was 40 ships and then it went down to about 26. You take out that many vessels, rates are going to run. So good, right? I mean, tanker owners were very happy, but unfortunately, there became this like short-term myopic focus just on the sanctions. So there was all these strategies of like, oh, we're going to just dump the stocks when the sanctions end, or we're going to short the stocks into the sanctions ending, because everybody knew the sanctions wouldn't last forever, right? Well, that happened last fall. Basically, the exact same kind of trading pattern just happened this spring, where we had COVID-19, and naturally COVID-19, it was a demand shock to the entire world, and all stocks initially, right in March, all stocks crashed. Well, this sort of theory came out, and it wasn't a bad one, but this theory came out that tankers would benefit from floating storage. And it was a decent thesis, but I think too many folks gravitated just onto the narrowness, right, of the simplicity of just that thesis alone. Well, what happens when everybody, piles into a stock and they all have like this one thing? It's floating storage, floating storage. Nothing wrong with that. But when it's pretty much everybody and they're all there for one reason, the second the contango goes away, the second the storage play ends, people are going to feel trapped. People are going to start dumping, or people are going to short expecting the floating storage to end. And sorry for the long-winded response, but I think it's kind of the same thing we saw last fall. We saw kind of the up and down with the Costco sanctions as folks forgot about the long term. And here we are. We see the up and down with floating storage, and folks are forgetting about the long-term positive fundamentals.
Yeah, that's very interesting. So I guess this explains the weakness just overall in the stocks of the oil tanker companies.
Yeah, I think so. And look, I mean, it's June, middle of June. We're recording on the 19th of June. If this is, I don't know exactly when you're going to post this. Uh, but this is the weakest season of the year for crude tankers. The summer fixtures are always terrible. I mean, there's been fixtures in the summer that are zero or negative even, like negative 2 or 3,000 for VLCCs, and that's normal. And those rates bleed into a weak reported Q3, quarter three, and then quarter four. So starting around August, September, October, the rates start to shoot back up again. It happens almost every single year. So like we're at the weakest part of the year, And we're in a sort of COVID-19 destocking on top of that. So I think when you look at the Aframax rates and the Suezmax rates and MLRs, I don't think there's anything really surprising there. In fact, what I'm surprised by is how well VLCC rates have continued to hold up. I mean, I think that's actually the biggest surprise.
And which companies benefit the most from the VLCC rates?
So that's a great question. So you want, if you're just trying to look at current rates, which again, I urge, folks to look at the long term and the overall valuations of these companies. But if you just care about the current rates, the best VLCC focused company is DHT Holdings, stock symbol DHT. They are a pure play. So every single ship in their fleet is a VLCC. And not only that, they have 10 of their ships on charters. Six of those ships are fixed at almost 70,000 and 67,000 a day, and the other four have a sort of profit sharing where they're fixed at like a floor around 30,000, and then there's like a 50-50 profit sharing on top. So not only are they VLCC heavy, they also have 10 of their ships fixed on time charters. So that's probably the best one just for like the current rate dynamics. Another good one would be Euronav. They have about half of their ships are VLCCs. And another one I like is International Seaways. They're about 40% of their fleet, a little bit more than half by deadweight tonnage is VLCC. But the valuations there are just really, really good. And they've refinanced their balance sheet. They have strong liquidity. They have a small share repurchase that they're doing. So yeah, that would be the big three that kind of benefit from this. The first one is DHT Holdings, DHT. The second one is Euronav, stock symbol EURN. And the third one is International Seaways, stock symbol INSW. And for disclosures, right, just so listeners are aware, I don't have a position in DHT, but I am long both Euronav and Seaways.
Okay. Now that you mentioned Euronav, just this question popped into my head. As you know, the people that hold Euronav, we all receive dividends, and there was this talk about how much Belgium was going to withhold, and I even had an interview with a tax professional, and he thought that Belgium was only going to withhold 15%, and it turned out that it withheld 30%. Do you have any suggestions for people what they could do to get the rest of the money back, or are you the wrong person to ask about these tax questions?
Well, legally speaking, I can't give tax advice, so let's make sure we put that out there. But I can share my opinion and my understanding of the situation. So, look, I am long Euronav, so I'm impacted by this as well. I hold them in interactive brokers personally. Uh, the Belgium tax treaty, U.S. Belgium tax treaty, it dates back to like the 1970s, and it's been ratified and updated more recently. It restricts dividend taxation to 15% in a taxable account. And my understanding is there's also some sort of side agreement that keeps tax-free accounts to zero. So if you have like an IRA or 401k, it should basically be zero tax-free. And if you have like a taxable account, it's 15%. Now, if you're a U.S. citizen, I don't know how many of the listeners are going to be in that situation, but if you're a U.S. citizen, you can also take your foreign tax hits and use those as credits, right, when you do your tax return. So if you compare Euronav on a taxable account compared to anything else, say ExxonMobil or Chevron or whatever other company, you have to pay taxes on your dividend, right? If it's a taxable account. So the net impact should basically be the same. Now, what I've heard and what I've seen as well, myself and Interactive Brokers, is the brokerages are taking a 30% withholding off the top. That's not actually Belgium's doing. What Belgium does is they send the brokerage basically an alert, when they pay out the dividends, and it says, hey, this is a foreign, tax dividend. Well, Belgium's tax rate themselves is 30%. Our brokerages are being too lazy to basically look at, the ownership, citizenship of the account owners, and in looking into these tax treaties. So the brokerages are basically being super lazy. And a lot of times when you call them on tech support, they give you all sorts of just asinine answers about like, oh, it's too hard to change the formatting of our system, and you'll have to contact our professionals and so on and so forth. So a lot of times folks have to use these services that do that for them, right? That look at your account statements and take more of a legal action, right, to get your money back. So it's not Belgium that's doing this. It's not Euronav that's doing this. It's just lazy, almost incompetent brokerages.
Okay, okay. So does it mean individuals should contact their brokerage company and get it settled this way?
That's what I would do first, and I would see, what happens. My Euronav position, is not super significant. Like my dividend amount is in the hundreds of dollars, not in the thousands. Just to put that in perspective. So it's not something that I'm sweating at this moment, right? I mean, because that money's my money, right? I don't need to act today to get that money. So my plan is to wait until, closer to the fall, closer to the end of the year, see if there's another dividend, right, in the fall, and then come to them with, one letter, one sheet that shows what they owe me basically, and that's my money. They definitely owe me that. So I'm gonna figure it out this fall. For folks that want to get more urgent on things, I would recommend calling and then sending a formal letter to your brokerage. If they won't deal with you, then there are services. One of them is called Global Tax. You can also seek perhaps legal and professional tax advice. Again, I cannot give you legal advice. I cannot give you tax advice. So we're just kind of sharing my approach to it.
Okay, perfect. Thank you. Going back to the tankers then. Are you surprised by the amount of destocking that's taking place right now?
I'm not an oil sector expert, right? So when he had all this debate a few months ago about like how much oil was going to be stored and that sort of thing, I participated from the side of shipping. I said, these are how many VLCCs are available. These are how many Suezmaxes are available. This is what will happen based on different scenarios. But look, I didn't really have a firm opinion one way or the other. But that said, yes, I actually am a little bit surprised about how fast demand has picked up. And it does kind of surprise me that the level of storage in onshore facilities was not higher than it was reported to be, right? Because you looked out and you could see from China especially, right? When you looked at Chinese numbers, we saw that their oil demand plummeted by 40% or more during their shutdown. What we saw is that in the United States and parts of Europe, the demand did not fall anywhere remotely close to 40%. I mean, it fell 15 to 20%. Part of that, too, is that refineries didn't shut down right away. So when we were measuring things in crude oil, you have to look at both sides of the equation. So first of all, you have the crude oil, which is just produced out of the ground and primarily sent to refineries, right? So that's only half of it. The other half is the refineries taking that crude oil and turning it into gasoline, diesel, jet fuel, and so on, right? So those refineries kept pulling that crude oil through and turning it into stocks, product stocks. And so what we saw was the build on crude oil was a lot less than we initially expected, but the build on products, at least initially, was a lot higher than we expected. So overall, when you look at total stocks, which I think is the way to do it, looking at both crude and product, I think the build was reasonable. I think it was within what we should have expected, but I think the crude build itself was less. And one other note on that, OPEC actually was compliant from what I've seen. Right? I mean, I know it's preliminary data at this point, but they made a massive cut in May, and it was set for May and June, right? Massive cut. And from what I've seen from the VLCC stems, from the reported export figures and production figures, OPEC has been compliant, almost over compliant in May and June, and that surprised me. And not because, again, I'm not an oil sector expert, but OPEC is almost never 100% compliant. At best, they're usually 75, 80, 85% compliant. So that was surprising. Secondly, OPEC extended their cuts through July. They made the decision about a week ago, and that's very bearish for crude tankers in terms of floating storage. Right, in terms of like global rebounding and rebalancing, you could argue that's actually bullish because it expedites the process. But if we're just talking floating storage, Marius, that was very bearish because that was OPEC taking even more oil off the market.
Yeah, interesting. Well, I think that, as you know, when the floating storage was building, really no one was giving credit to the earnings that these companies were making. So I think that actually everyone will be benefiting more if we actually go through this destocking faster, the oil markets rebalances faster, and we can get back to the thesis that supply and demand thesis that actually started in 2019.
I hope so. And it's very interesting to see that these tanker companies made, Q1 of 2020 was for most of these companies record earnings, right? And for many of them, Q2 might even be stronger. For some firms, it's going to be similar. For a couple firms, it'll be a slightly stronger, slightly weaker, but more or less, Q2 is going to be just as strong, if not stronger, than Q1. And the market gave, you're absolutely right, the market gave zero credit to all these tanker firms. And so it's like, what's it going to take? Everyone's so focused on like the next, weakness. And so we even started talking, I think it was last week, folks started talking about these Venezuelan sanctions. And maybe that, I don't know if that was something you wanted to talk about, but and I was almost thinking like, yeah, I was kind of rolling my eyes because I'm like, yeah, this would be amazing. This would be good for earnings. But oh man, now we're gonna have another up and another down, and everyone's gonna be like, oh, short them because Venezuela sanctions won't last forever. So it's like we can't catch a break. It's like every time there's like good earnings, everybody like totally ignores all the good earnings and is just focused on like the weakness ahead.
Right, they're just petrified of the cliff, and if they're just petrified of the short-term pain, whether it's months or half a year or whatever. But I think that the moment that they don't see any pain ahead of them, it doesn't matter that the rates are going to be quarter of they were. I think they're going to pile into these names just because there's no pain and no cliff in the next year or so.
Well, I hope you're right. Fingers crossed on that. I would say that if you look at the dry bulk sector, you can see that sort of happening right now. That a lot of these dry bulk stocks are getting attention. And look, the dry bulk fundamentals, medium to long term, are not that great. Dry bulk is not really a space I want to be in for several years. But it's an amazing place to be in for the summer, right? It's a really good seasonal trade, and you can see that these stocks were at the earnings were basically at like almost near record lows. All the companies were in pain. We saw that follow-on offering by Scorpio Bulkers, right? I mean, it's not a great situation, and yet the rate started lifting a little bit, like off the floors, and the stocks are starting to run. So I think you're right. I think if we get into the fall or the winter and tanker rates are not very good, it might actually be. It's like perverse. Like it shouldn't really work this way, but it might actually be a positive for the stocks because the rates can only go up.
You see, from our point of view, what should happen and what will happen are two different things, because obviously from the point of view of cash flow, we were very happy to see that these companies were making so much money repairing their balance sheet, and we thought that they should benefit from that, and they didn't. So sometimes just the markets are the way they are, and we just have to go with the punches.
Yeah, absolutely. Well, I've been following the shipping sector for about 11 years now, and very rarely do things make complete sense, right? There's all sorts of volatility like this. There's all sorts of weird little catalysts and ups and downs, but that's what makes shipping such a profitable area, both to traders, right? I think there's a lot of traders that made a lot of money in tankers, even though, right, they went up and down, and then also to investors who have patience, right? Investors who are able to come in and understand the longer term cycle and select strong companies, right? They don't get tied up in some of these sketchier, weaker companies that are going to dilute, but they pick some of the stronger ones. I would say companies like the DHTs and the Euronavs, and they're able to buy them right at discounts and have patience, right, and be able to ride the cycles. So I've seen that, Marius, for 11 years. So as much as as much as it annoys me and bothers me, it's nothing new in shipping, and that's just the way things are going to be, and that's okay. There's still ways to profit from it.
Yeah. Okay. Um, some people asked me about the VLCC app that we can all download to kind of keep an eye on the rates for VLCCs. Um, could we maybe take a moment and go over like a fixture line by line, so that you can explain to people what some of these things mean?
Yeah, we can do that. Just let me know. I'll pull up the app and let me know which fixture you want to go over, and we can try to go through it. Yep.
Okay, so let's go through the Mermaid Hope fixture 2011. It's on my phone it's the third one from the top, and what I will do, I will take a picture of it and put it up in the video so that people can follow your explanation.
Okay, excellent. Yeah, I have that pulled up on my screen here. And then, of course, you can also follow these on Twitter. I follow them on Twitter, and sometimes I'll make comments or retweet or so on if folks want to do that. Yeah, on the app here, I see Mermaid Hope, and yeah, it's 2011. So that's just, of course, letting you know how old the ship is when it was built. They're calling it modern because this app will basically call anything over 2010, less than 10 years modern. So it kind of just divides the ages in half. So, less than 10 is modern. And then it says it has a scrubber. So it's important to realize that the scrubber allows these vessels to burn what's called high sulfur fuel oil. So in 2020, there's this regulation called IMO 2020, and it requires you to use scrubbers to burn the old, nastier fuel, right, to clean it up, or you have to use a newer, more expensive fuel. Those spreads have came down quite a bit, so it's not quite as profitable to have a scrubber as it used to be, but it's still a positive. So we should note that the Mermaid Hope is both. It's not really. I don't really believe it's modern, but that's what the app is calling it. And it has a scrubber. So this is maybe a little bit better than some of the older ships. So that's the first part there. Next part, it's a status and when it was reported. So on subs means on subjects. So that means there's basically been a baseline initial agreement for this ship to go into service and do this cargo route. Normally, the way this works, it takes about 3 to 5 business days for that to go from on subjects to fully fixed. Fully fixed means that they've contacted the ports, they've contacted the company, they've confirmed that it can arrive on time, that it meets like the initial due diligence and vetting. Basically, that it takes it from basically verbal agreement to written agreement. That's kind of oversimplistic, but that's basically what's happening there.
So it's kind
Uh,
of like if you're buying real estate, it's under contract versus closed.
I think that's absolutely right. It's like being an escrow. Um, it's coming from Zhaozen, so that's just letting you know where it's coming from. The ship is coming from China there, and then the open date 14 June 2020. So that is when the oil was discharged from the last cargo and when the ship was looking for a new job. So it only took 3 days from open until reported subs. So that's pretty good, right? That's a pretty tight market. In a super tight market, Marius, I mean, when things are just going crazy, sometimes you'll actually put a ship on subjects, well, it still has oil from the old cargo. So if you ever see where it says like status reported and that date is before the open date, oh man, that's just like a strong market. So 3 days later, that's pretty fine. Operator, Clear Lake, that's basically who just controls that ship. The trade is going from the Arabian Gulf, the AG, and sometimes we call that the Middle East Gulf to be more politically correct there. That's the AG to Taiwan, right? So that's kind of just the route it's going to take. And so it's coming from, that sort of China, Taiwan area. It's going to go over to the AG, the Arabian Gulf. It's going to pick up the cargo and it's going to bring it back to Taiwan. So basically just a round trip. CPC is who is chartering that ship. That's just the customer. The rate, WS is world scale. World scale is set each year, and it's based on like a formula that basically converts the tonnage to a raw figure, a raw rate, like 8 million, 10 million, whatever. That's not the same as time charter equivalent. For us investors, we care about time charter equivalent because world scale, that might be okay if you're, an oil broker or something, but that doesn't really tell us how much the ship itself is earning. That tells you how much the cargo is costing. But our earnings are going to fluctuate based on the price of bunker fuels, based on the port fees, based on the delays, based on the fine print in the contract. So world scale is good for brokers, but it doesn't really help us much. So I usually kind of skip that. Laycan, 1 to 3 July, that's the estimated range at what point this oil tanker is going to fill up with oil. So you see, it got reported 17 June. It's coming from its last cargo at 14 June. So from 14 June, it started steaming, I would imagine, towards the Arabian Gulf, right? Then it got the contract of the 17th, so it's still kind of steaming towards the Arabian Gulf. It's going to arrive in early July, and then they're going to fill it full of oil. It's going to turn back around and it's going to head out to Taiwan. So that's just kind of geographically what's happening. The actual time charter is 54,059 a day for 41 days. So that's the actual duration of the hire of this voyage. That's just based on, no kidding, how much they're getting paid, where the actual ship is at, where it's going to, and where it's offloading. And it's important to realize the accounting method for a ship is discharge to discharge. So the way these earnings will be accounted for are the open date, which is 14 June, through the laycan, which is 1 to 3 July, through the next discharge. The way you can figure out how long that's going to take is if you look down to the next line, it says RV. That's round voyage. That's a round trip. And that's 55,927. So basically 56,000, 39.9. So basically 40 days. That's saying that the round trip distance between the Arabian Gulf and Taiwan and back again is 40 days, right? So the difference between actual and round voyage, actual depends on where the ship is at. So like if the ship was like advantageously located, like it was already closer to the AG before it got hired, that actual might be a lot higher. because they don't have to spend a lot of days on a ballast leg, right, being empty. The round voyage is just a flat. It's so you can compare apples to apples, right? If you have two different AG to Taiwan fixtures and you want to say which one's stronger, you want to look at the round voyage because that's always going to be about 40 days. If the ship is in that same location, like in this one, it kind of was, right? It was very similar. It was coming from basically Asia, going to AG, back to Asia. You can see that they're basically the same, right? The actual and the RV are the amounts are almost identical. The days are almost identical. Does that make sense?
Yes, yes.
I get a lot of questions on that because sometimes you'll have an actual number that's like super high and you'll have a round voyage that's low or vice versa. What do I look at? So when I'm gauging the strength of the market, I look almost exclusively at the round voyage, the RV number, because that is showing me apples to apples how strong that route is. Now, if I own that tanker, right, if I look and it's one of the, say, DHT's tankers, then I'm a little bit more interested in the actual. Does that make sense? Because that's the actual earnings of that tanker.
Yes.
So that's how I kind of differentiate between the two. The rest of the stuff, not necessarily that important, but it just shows the speed. Ballast is when you're empty. Laden is when you're full of oil. It's going 15.4 knots when it's empty. It's going 13 knots when it's full. That's fairly fast. So that's just indicative of the stronger market conditions and the cheaper bunker fuels. If the market gets weaker and the bunker fuels get more expensive, then we can expect those speeds to back off a little bit. Idle days, yeah, just showing you that it's not very idle. It's only half a day. That's pretty good. And then ballast laden port, that's the percentage of time. So remember this, it's 41 actual days, right? If you look at the actual TCE. So it's saying 40% of those days are going to be when it's empty, 43% are when it's full oil, and 17% of those 41 days are basically going to be the time spent unloading and unloading. So I think that covers most of it. The last part I'm going to note is at the bottom there. It says lay time demurrage. It's saying that 120 hours are expected lay time. That's how much time is in the ports. That's to be expected. That's part of the contract. The demurrage rate, if it goes above and beyond that, is $50,000 a day. So if there's some sort of port congestion or something weird happening, the owner of this tanker is going to get $50,000 per day until it's resolved. And keep in mind that 50,000 is pretty profitable because there's really no bunker expenses because the ship is parked. So that's a pretty good rate to have on demurrage.
And what about the break even TCE?
So that is just a calculation that the app does. That is just saying what the company needs to produce break-even earnings. So the app is just saying by our projections, that's based on their internal models. They're saying they need about 28.6 to break even on earnings, which yep seems reasonable. And then if you want to give a 10% return, you need to get about 36,000 GCE. So yeah, that's just an internal calculation. And as you can see, 36,000 is 10% return. That's kind of mediocre but decent. This ship is getting 54,000 actual, so it's a pretty darn good fixture.
Okay, so that's this. And could we go over the cargo count tab?
Yeah, sure thing. So we'll scroll over here and click on cargo count, and this is something I'll look at once in a while as well. This just shows it splits it up by decade. So decade is a shipping term that just means 10-day periods in the month, but it splits up the expected loadings and the fixed loadings for each of the three main basins. So the three main basins up top, the first one's the AG, the Arabian Gulf. Again, a lot of people call it the MEG, the Middle East Gulf. WAF, which is West Africa, WAF, and then Caribs, which is basically anything ranging from the U.S. Gulf up north down to Brazil in the south there. So Caribs is kind of a really broad definition there. As you can see, if you look at the AG, you can see that little dash line. Again, we're recording on 19 June, so it might be a little different if you're listening later, but you can, and I understand you're going to put a screenshot up. So you can see kind of the dashed lines out there. That's the average. And as we can see, the fixtures 1 to 10 June were just 39, way below average, right? 11 to 20 June, just 30. Huge drop, way below average, like almost only like maybe 55, 60% of the average. And then 21 to 30 June is 47, which is higher, right, than the last two numbers, but still well below average, right? So what that's showing us is the number of fixtures of loadings from the Arabian Gulf throughout June. And as we can see, they're way below average. And those numbers correspond to about 100% OPEC compliance, maybe even more than 100%. So that's what I was kind of saying earlier, and when I was, answering that question about weakness. Look, OPEC is actually sticking to their cuts, and that means they're hiring less and less tankers. And that's why I said when they extended those cuts into July, that's a bearish thing for us because it means that the fixtures in July are going to be closer to, I would guess, about 40 per 10-day period. Normally, that's closer to 60 per day, 10-day period. So think about that. That's 20 less VLCCs that are getting hired every 10 days. That adds up. We really, really need to see continued storage or to see continued port congestion to offset that. Look, we saw that in June. Rates are still pretty darn good. 50,000 is a great rate for June. In July, I think rates are going to have to come off unless there's some sort of weird impact like sanctions or something, because we're still going to see low fixtures throughout July. Now, August is when we can expect those to bounce back closer to about 50 per 10-day period. Same thing for West Africa and Caribs. I would note that West Africa and Caribs are actually much, much stronger. If you look at 1 to 10 June in West Africa, it was only 9, but then it increased to 12 for both the second and third decade. And if you look into July, there's already fixtures that are lining up. You go down to Caribs, and you can see that Caribs started out super weak, just 7 fixtures, and you can see that it exploded up to 15. 15 is almost an all-time record for the Caribs. That's very impressive. And then 13 in the back of the month. And then as you go into July, look, they're already fixing into the middle of July, right? I mean, a whole month ahead. So the Caribs is very strong. And remember, the Caribs is either the U.S. Gulf or Brazil. And those are very long routes, right? To go from U.S. Gulf to China, or U.S. Gulf to India or Korea, or to go from Brazil to China. That's a very long route. So when we see those numbers going up, those can compensate for the lower numbers in the Arabian Gulf. So hopefully that's just an overview and helps folks kind of understand how to look at that tab.
Yeah, absolutely. I think that's fantastic. I know a lot of people have been asking about this information, so I appreciate you going over this. Yeah, so I think this was a fantastic update on the market and the oil tanker stocks. Yeah, I don't have any more questions. Anything you want to add before we wrap it up?
No, I think we did a pretty good job covering it. I appreciate you swinging back, Marius. It's been kind of an emotional roller coaster, for a lot of folks in the market. And one thing I've seen, like I said, I've been here 11 years, and we've been providing research for 5 years. A lot of folks come in and are focused on one little short-term catalyst, and that's okay. But if you're focused on a short-term catalyst, make sure that you understand that you're kind of a trader, right? You're just trading the market. So whenever the catalyst changes, if you're going to be like a day trader, a week trader, or a trade for a month or two, a cycle trade, whatever you want to call yourself, just be self-aware of that, right? Now, if you're truly an investor, right, and you're making an investment into the longer term, then remember what those fundamentals are. Remember why you bought the stock, and then keep your eyes on the long-term supply and the long-term demand. I think if folks kind of self-sort themselves into the trader bucket and into the investor bucket, and they act kind of accordingly, I think there'll be a lot less of like these weird like sort of emotions. Because I've seen it on Twitter. I've seen folks getting frustrated and like what's going on and blah blah blah. And look, it's just we see this all the time in shipping. We see a lot of folks that they invest for the long term, but then they get too wrapped up into the short term, or vice versa, right? They're making a short term trade, and then it goes against them, and they get too, I guess you could say, stuck. So that would be sort of my advice, I guess, to the folks that have kind of recently joined us.
Yeah, perfect. Thank you very much for your time and have a good weekend.
Of course, thanks, Marius. You too.